Hello everyone, and thanks for joining me. Today we're going to look at a detailed guide of how to invest £1,000 if you're new or relatively new to the stock market. I've got a bit of a map here for you. So you've got your £1,000 or $1,000, whatever your currency is. And I think the first thing you need to think about is your required rate of return. So you've either got some financial investing objectives, and if not, I will leave a link at the end for a box set where you can have a look at a video that describes how you could go about constructing investing objectives. You need to understand what you want to achieve before you actually decide which method of investment is best for you. Because I've got 5 scenarios for you, depending on what you're looking to achieve and the level of risk you're willing to take. You know what? You've got option 1 here, which is passive mode. Now, passive mode is when you invest in index trackers and effectively you can just lock them away and let them go, come back in 5 years. And the other alternative here is active mode, when you're actually picking more individual stocks. You've got a lot more time on your hands, you're monitoring the market. You know, if you need a return of, let's say, 5 to 8% a year, then passive mode is probably more suited to you. Whereas active mode, if you're looking for 10% plus a year, you're probably going to need to start picking individual stocks. So it's really critical to understand your percentage of return that you want to achieve. And the other thing, actually, before we even do that, is if you've got any high interest debt, you're probably going to get a higher return paying that off with 1,000 than if you actually are going to invest. So the other thing here is time. So I'm assuming here you've got at least 5 years, and if not longer. So this is very much a long-term situation. If you've got less than that, then there's an increased risk of capital loss, if you've only got 12 months, let's say. And of course, that is the risk that permeates all of these, is the risk of capital loss. But in kind of the passive mode, that's perhaps less likely, although the upside is less likely as well. So passive mode, you need to look at your brokers, so who you're going to use to invest. And with brokers, you need to look at fees, reliability, kind of the access to different instruments that they've got. Are they actually easy to use? And then do they offer the tax-free wrappers, which are dependent on your country? So in the UK here, that is an ISA, where you can invest £20,000 tax-free. We've got Highway Standards and Vanguard as 2 examples. And the reason is they've got a very wide range of funds and very low fees on those funds. On the active side, you've got several brokers there, and more importantly, they'll have low or nil trading or transaction fees. And there is a free trade and interactive brokers link below, and the free when you could get a free share worth up to £200. I've now got 2 scenarios for you on the passive side. And the active side, that's scenario 3, 4, and 5. And scenario 1 is going to be the simplest, lightest touch, kind of lowest risk, perceived risk. And then scenario 5 is going to be the much more active and looking at smaller companies. So I'll just take you through those 5 scenarios. You can work out what fits best for you, for your own circumstances. So scenario 1, I think, is really simple. Our old friend Warren Buffett, very clear, never bet against America. And his view is, if you don't know what you're doing, put all your money in the S&P 500 and you will make a decent return over time. So scenario 1 is very simply 100% of your £1,000 into the S&P 500. And what you might do is you might think, actually, the S&P 500 is pretty highly valued at the moment. Therefore, we wish to take an alternative approach. We wish to spread that over several markets. So in this case, I've suggested 20% in each, but I put Australia slightly less because it kind of overlaps with Asia Pacific a bit, and that extra's gone into the S&P 500. So S&P 500, the world's premier market. I think Asia Pacific, there's going to be a lot of growth there in those markets probably over the next 10 years. FTSE 250 is the faster growing UK market with sort of the smaller organisations. China is growing and that middle class is growing. And Australia's always had a very good kind of market as well. Spreading over 5 reduces that reliance just on the S&P 500. So those are the passive scenarios. We'll now have a look at the active. With the active, I'm suggesting scenario 3 is 5 stocks and 20% in each. These are perhaps in the lower risk side, so these are dividend and income stocks, perhaps more suitable if you're close to retirement or you want an income. And the 5 stocks that I'm suggesting are stock 1, Boon Group, very low P ratio and low payout ratio. Looks like it's undervalued. So you've probably got some capital upside and growth, potential future growth to the dividend. Stock 2, another American company, Walgreens. Again, there's probably scope for that share price to double over the next 5 years, in my view, and they pay a 4% dividend. And we're coming over to the UK for the next 3 for dividends. So Aviva is stock number 3, over 5% dividend, and there's some additional returns coming to shareholders. British American Tobacco, 7% dividend, priced roughly at book value. And then stock 5 is Tesco, dividend that's over 3%, very stable business here in the UK, leading the grocery sector. Oh, I did post very recently 5 dividend stocks to buy, which has a bit of an overlap with this list. So if you want to know more about most of those stocks I've just mentioned, I'll leave a link down below for that. Also, a more in-depth view of Tesco, and the link for that should be appearing on screen now. Now, scenario number 4, we start looking at something where there's perhaps a bit more capital growth, so not so much income stocks or dividend stocks. You're now starting to look at the kind of mid-sized companies, or even larger in some cases, where they're looking a little bit undervalued and there's room for them to grow. And in this case, I've only going for 4 stocks and 20% cash, because I think with these companies, with the market fluctuations that are inevitable, there is an opportunity to then hold that 20% cash until one of these 4 potentially becomes even cheaper, and that cash to be deployed, sort of double down, average in to that stock, whichever one it is. Stock number 1 is Corsair Gaming. It's just over $30. I think that one, the P metrics are looking very nice. There's a lot of growth in that company, and the quality of the product is very high. Stock 2 is Discovery. There is a little bit more risk in that than some of the dividend stocks, a little bit more debt on this one, but it looks really undervalued, and their kind of direct-to-consumer offering is growing very, very rapidly. I think it's up to something like 15 million subscribers in a matter of months, and there's a lot more upside potential. Stock 3 is Alibaba, and that has dropped dramatically in price from $300 or so last year. We're down to just over 200 now. And there's a lot of growth in the company, and it looks undervalued. Then stock 4 is Intel, so it looks undervalued, it trades at very cheap rates, and it does make attractive margins. With all these 4 stocks, there is a bit more risk than the previous scenario 3 that we looked at. Of course, some people think, well, once everything's open, people will be going back out again. Not sure myself. I think if you like your computer gaming or your streaming, you're still going to do it, even if stuff's opened up. Discovery, there's the merger. There might be a bit of risk associated with that. Alibaba, there's always the potential perceived regulatory risk. And then Intel, there's some risk there because they're a little bit behind on some of their chip development compared to competitors. I still think they're a really strong company. But they are all companies with good growth potential, and to me, they look undervalued. So we get to scenario 5. So it's the same basis, 4 stocks and the cash as the previous one. We're now looking at much smaller cap companies that are growing much more rapidly. So the reward is probably higher. Again, the risk that you're taking here is also a little bit higher as well. And when I talk about risk, there's a couple of things here, but the most important is permanent loss of capital. That's the worst that can happen. And then the second part of that is losing money. So I don't think any of these stocks are likely to result in permanent loss of capital, although I could be wrong, of course. But I think there is a chance, perhaps, or an increased chance compared to the others, that some of these you may end up actually, because of competition, because of other factors, they're perhaps growing too fast, you may not get all your money back. Now, the 4 that I picked here, I own all 4 of these, so I don't think that's going to happen. So stock 1, K3 Capital Group. Very small company in the UK. I think revenue's under 50 million. Lots of insider ownership, excellent growth, results are good, and they provide business services. Number 2 is Kelly Partners Group Holdings. This is an Australian accountancy company. Management looks really strong, and they're all about kind of compounding at that sort of 20 or 30% rate. The way they run the company and what they're trying to do looks very impressive. Next up is GAN, and they provide kind of some of the platform infrastructure for some of the online kind of gambling sites. They just released some really good results in the last week or so, very much ahead of analyst expectations. And then last but not least is TTCF, Tattooed Chef. relatively low market cap, although I think it's bigger than the other three I've just mentioned. We're still in the single digit number of billions. And I think there's a long runway here based on the work that's being done and the fact they're in many stores. And they've got that unique vertically integrated model and the branding as well. So they look very strong bet. Particularly now they're trading around about 20. Anything below 20 looks like a steal to me. So those are the 5 scenarios. If I were to start from fresh today, I had no investments, I had to invest £1,000 or $1,000. Now I didn't mention other possibilities because I don't think they're in the core, but there are other things you can do. So I didn't mention a commodities portfolio, so you might be investing in oil, for example. I didn't mention copy trading, which you don't need eToro. And I didn't mention mutual funds. We talked about index trackers, but I didn't mention mutual funds, which is where you've got your fund managers running your money for you. And the final thing that I didn't mention is putting everything in one company. The very richest people, and most of their money, pretty much without exception, are putting all of their money into the stocks of one. Most of the richest people get rich off the back of one company. Now, if you're investing your first £1,000 or $1,000, that isn't necessarily the right thing to do because you put all your eggs in one basket, and perhaps that's too much risk for your first kind of interaction and foray into the stock market. So I hope you found that useful. Details for my Patreon on the board there if you want to see what I buy or sell positions or get my discounted cash flow template. But hopefully it's given you some ideas and it helps you out if you're trying to invest your first 1,000. Thanks for joining me. Have a great day.